A machine costs $8,000 to purchase and install and has a useful working life of 5 years. It will be depreciated on a diminishing value basis to a book value of 0. The depreciation rate is 2 divided by the life of the asset in years, which is 5, giving us a depreciation rate of 40%. The depreciation amount in the first year is 40% times the book value at the beginning of that year, or $8,000, giving us depreciation of $3,200. And the book value at the end of the year is the book value at the beginning of the year, $8,000, minus the depreciation in that year, $3,200, giving us a book value of $4,800. In order to calculate the amount of depreciation each year under diminishing value, we can set up a table like this. The book value at the beginning of year 1 is the cost of the machine, $8,000, and as we've established, the depreciation in the first year is $3,200, giving us a book value at the end of the first year, and therefore at the start of the second year, of $4,800. The depreciation in the second year is 40% of $4,800, or $1,920, giving us a book value of $2,880. The depreciation in the third year, 40% of $2,880, which is $1,152, and so on. 40% of $1,728 is $691, giving us a book value at the beginning of the fifth year of $1,037. If we continue calculating depreciation in this way, we would have depreciation of $415 in the last year and an ending book value of $622. However, at the beginning of this example, we were told that we depreciate down to a book value of 0, and therefore if that's the case, we would normally depreciate all of the remaining book value of the asset in the fifth year to give us a book value of 0. As was mentioned earlier, the purpose of depreciation is to spread the cost of an asset over its useful working life in order to match revenue and expenses for accounting purposes. However, since depreciation is not a cash flow, we don't include it in the calculation of NPV. We include the initial cost of the machine when it actually occurs, at the beginning of the project. A fundamental principle behind Australia's tax law is that all costs associated with earning revenue are tax deductible. And we find that if we add up these values, the total amount of depreciation is $8,000. The $8,000 cost of the machine has all been claimed as a tax deduction, but through depreciation rather than claiming a tax deduction at the beginning of the project. We can compare this table with a similar table for straight line depreciation. Instead of these amounts occurring per year, the depreciation is $1,600 per year. But at the end of the day, the book value of the machine is 0 and the total amount of depreciation is $8,000. The important difference is that under diminishing value we have more depreciation earlier in the life of the asset and less later in the life of the asset, and we would rather this on the basis of the principle of the time value of money.